Welcome back, esteemed traders and dedicated students of the market. In our previous session, we meticulously dissected the foundational philosophy of price movement. We uncovered the fundamental why behind every tick and every trend, revealing the invisible hand of the interbank price delivery algorithm, or IPDA, as it orchestrates the hunt for liquidity. We learned that the market is not a random walk, but a clinical, purposeful mechanism designed to move capital from the uninformed to the informed. We understood the critical importance of market structure, the deceptive nature of inducement, and the precise mechanics of stop hunts. We concluded Part 1 with the understanding that price is a tool, a means to an end, and that end is always the acquisition of liquidity or the rebalancing of inefficiency. Today, we embark on the second, equally crucial phase of our journey. We transition from the why to the how. We move from the philosophical underpinnings to the tangible, actionable reference points that allow us to align our trades with institutional intent. This is where the abstract becomes concrete, where theory meets application. This is where we learn to read the footprints left by the smart money, not with indicators that lag, but with the raw, unfiltered language of price itself. This is not about prediction. It is about recognition. It is about waiting for the market to reveal its hand, and then, with the same cold, calculated precision as the institutions themselves, stepping in. The transition from understanding why the market moves to knowing how to participate is the definitive step from student to professional. We explored the why, the hunt for stops, the traps of inducement, and the reality of market structure. Now we examine the specific footprints left by the algorithm, the structures that signal institutional entry. We move from philosophy to execution. This is not about guessing. It is about recognition. It is about waiting for the market to reveal its hand, then stepping in with cold, calculated precision. This shift in perspective is paramount. Retail traders often predict. Institutional traders react to confirmed intent. They wait for the market to show its hand, to leave its indelible mark. Then they act. This is the essence of high-probability trading. It is not about being first. It is about being right, consistently. To be consistently right, we must understand the specific price action signatures that precede and accompany institutional order flow. The most significant footprint an institution leaves is the order block. To the untrained eye, it's just another candle. But to the discerning institutional trader, it's a zone of profound significance, a high probability area of support or resistance. An order block is a specific candle or string of candles where the largest players have placed their orders, initiating a powerful move. Precisely, a bullish order block is the lowest down close candle immediately before an energetic, sustained move higher, characterized by displacement. Conversely, a bearish order block is the highest up close candle just prior to a sharp, aggressive, sustained move lower, also accompanied by clear displacement. These are not arbitrary formations. They are indelible marks of institutional entry. Let us delve deeper into why these order blocks exist. When an institution wants to acquire a massive amount of a currency, they cannot do it all at once without dramatically moving price against their desired entry, leading to slippage. They must execute orders in stages, often leaving a portion unfilled. When price returns to that initial down-close candle, the bullish order block, it's not coincidence. It's the algorithm, the IPDA, returning to a precise price point where institutional buy orders were placed, but perhaps not fully filled. The market, in its drive for efficiency, returns to these blocks to recollect those remaining orders. This allows institutions to complete their position at a favorable price. This return to the order block is a deliberate, engineered event, not random fluctuation. Think of an order block as a profound change in the state of delivery. It's the last point of significant selling before a massive buying campaign, or the last buying before an aggressive selling campaign. When price returns to this candle, we look for a decisive reaction, observing if the market respects that candle's integrity. Crucially, if subsequent candle bodies close through the order block, the institutional order flow is negated and the block is invalid. However, if price merely wicks into the block or touches its extreme, then decisively rejects it with strong candle closes, we have powerful confirmation. This confirms the institutional order flow is still in play, and the algorithm is fulfilling its mandate. This is the precision we seek. We are not buying near a level. We are entering at the exact candle where institutions initiated their move. Let us reiterate for clarity. An order block is not a generic support or resistance level. It is a specific price point where the algorithm has a clear mandate to facilitate institutional orders. When you observe a bullish order block, you see the indelible footprint of a buyer so immense their actions cannot be concealed. They've left a trail, a signature of their entry. When price returns to that down close candle, the algorithm communicates, here is the price you desired. Here is the opportunity to complete your position. The powerful rejection that follows is the institutional buyer completing their campaign. Conversely, a bearish order block represents the last buying before a significant institutional sell-off. Price returns to this up-close candle for institutions to complete distribution before the market is driven lower. This is why order blocks are potent. They are based on institutional necessity, not fleeting retail sentiment. Alongside order blocks, we must understand fair value gaps and liquidity voids. These are unmistakable signatures of urgency, telltale signs of rapid, one-sided price movement. When the market moves with extreme velocity, it creates an imbalance. A fair value gap occurs when price moves so aggressively it leaves a hole in price action, a range where only one side of the market was served. Specifically, in a bullish expansion, a fair value gap is observed when a large up candle forms and the wick of the preceding candle and the wick of the succeeding candle do not overlap. This non-overlapping range represents an inefficiency. The algorithm, in its relentless quest for true fair value, will almost invariably return to this gap to rebalance price action. It is a clinical repricing event, a necessary adjustment to ensure all price levels are properly traded. Consider why the algorithm performs this rebalancing. The interbank price delivery algorithm is designed for efficiency and fair price discovery. It aims to offer every price level to both buyers and sellers. When price moves too rapidly, it creates an unfinished business. A fair value gap is precisely this, a clear indication the market was overwhelmingly one-sided, leaving a segment untraded. By returning to that gap, the algorithm facilitates the participation of the other side, effectively filling the hole and ensuring comprehensive price action. This is not a reversal, it is a clinical rebalancing. Once the fair value gap is filled, the market achieves temporary fair value and is free to continue its original direction. This understanding allows you to view retracements not as threats, but as opportunities. Understanding this allows you to maintain a calm perspective when price retraces. You no longer view a pullback as a potential trend reversal. Instead, you recognize it as the algorithm performing necessary maintenance. This insight empowers you to utilize fair value gaps as high-probability entry points. When price retraces into a fair value gap that aligns with an order block, you've discovered a powerful confluence of institutional reference points. This confluence represents a zone where the highest probability trades are found. You are entering at a level the algorithm is practically guaranteed to visit, not to reverse, but to rebalance, then reject, continuing its original trajectory. This is the art of waiting for a superior entry, minimizing risk and maximizing reward. Let us expand on the liquidity void. While similar to a fair value gap, a liquidity void manifests on a larger scale. It's characterized by sudden, violent, rapid price movement, leaving a massive, porous area. These voids are not merely gaps, they are zones where price moved so fast that virtually no opposing orders were filled, creating profound imbalance. These voids act like powerful magnets. The market, driven by the IPDA's mandate for efficiency, will almost always return to fill a liquidity void, often entirely. If you see a massive candle that moved 50 pips in a minute, you're witnessing a liquidity void. Do not be surprised when price eventually grinds its way back through that entire 50-pip range. The algorithm must ensure price action is thoroughly solid and balanced before proceeding to its next major objective. These voids are not to be feared, but understood as inevitable rebalancing targets. To truly master execution, we must integrate premium, discount, and equilibrium. This is the inherent logic of the marketplace. No astute business person buys high or sells low. The same applies to institutions. When we analyze a significant price range, from a distinct swing low to a swing high, the 50% level is our equilibrium. Price above 50% is premium, expensive for buyers, attractive for sellers. Price below 50% is discount, attractive for buyers, unattractive for sellers. This framework provides an invaluable filter for trading decisions. If our institutional narrative is bullish, we do not buy in a premium. We patiently await price to retrace into a discount, below the 50% equilibrium. Here, we find high-probability bullish order blocks and fair value gaps, offering superior entries. This is the essence of optimal trade entry, or OTE. It's a sophisticated pricing model, a convergence of time, price, and value. We seek the market to return to a deep discount, ideally within the 62 to 79% Fibonacci retracement levels of the preceding impulse leg. This zone offers lowest risk and highest reward, as the algorithm offers the market at a sale price before the next expansion. This is where we align with smart money's acquisition strategy. Let us emphasize this. Many aspiring traders falter here. You may identify a perfect order block or FEG, but if they reside in a premium zone for a buy, probability is diminished. The algorithm buys low and sells high. To ignore this is to trade against smart money. By patiently waiting for price to enter a discount for a buy or premium for a sell, you align with market logic. You exercise professional discipline, waiting while the impulsive retail crowd acts prematurely. You wait for the fair price. This filter eliminates vast low-probability trades. Ask yourself, am I buying at a discount or a premium? If premium for a buy or discount for a sell, have the discipline to walk away. No exceptions. Time, often overlooked, is perhaps the most critical factor in ICT 2016 core concepts. Price moves according to a meticulously orchestrated schedule. The IPDA operates on a 24-hour cycle, but not all hours are equal. Certain windows are more significant, prone to institutional activity, offering higher probability setups. We begin with the Asian range. This is typically a period of consolidation, where the market builds orders on both sides. It is the quiet before the storm. We do not trade the Asian range. We use it as a benchmark. Its highs and lows are the first targets for the London session. Let us focus on Asian range behavior. This period, typically 8 p.m. to midnight EST, is characterized by a narrow trading range. Liquidity thinner and major directional moves are less common. The market oscillates, accumulating orders and building internal liquidity. Retail traders place stops just outside these boundaries, anticipating a breakout. For the informed trader, the Asian range is not a trading opportunity, but a setup phase. Its highs and lows become critical reference points, clear pools of liquidity, buy stops above high, sell stops below low, that the algorithm will likely target during active sessions. Understanding this preparatory phase allows us to anticipate the initial directional bias and potential for a Judas swing during the London Open, as the algorithm clears accumulated orders before the true daily trend. This is about patience and strategic observation. The London session often sees the first major decisive move. This period, typically 2 a.m. to 5 a.m. EST, frequently hosts the Judas swing, the false move from part 1. London often drives price to run stops above or below the Asian range, capturing liquidity. If the daily bias is bullish, London might drop below the Asian range low to hit sell stops before reversing and trending higher. This clears the path for the true objective. Transitioning to the New York session, 8 a.m. to 11 a.m. EST, we often see a New York reversal or New York continuation. The New York Open is a high probability window for the true daily move to accelerate. Grasping these session relationships means you stop chasing price and start waiting for kill zones, specific windows where the algorithm delivers high probability setups. You trade when big money moves, aligning with the interbank market's clockwork clock. Now let's synthesize these concepts into the full institutional trading model, step by step. And this is the repeatable framework for high-probability trading. It begins with liquidity. Identify a clear pool, an old high or low, equal highs or lows, or Asian range boundaries. These are the targets. Await the raid, the stop hunt. Immediately after, look for displacement, a sharp, energetic, one-sided move breaking market structure and confirming institutional intent. This leaves a fair value gap or order block in premium or discount. This is our signal. Do not chase displacement. Wait for the retracement to that FEG or order block, eventually entering our trade. Stop loss behind the order block or stop hunt swing. Target the next liquidity pool. This sequence, liquidity, displacement, retracement, continuation, is the heartbeat of the institutional model. Let's walk through an example. Market trends higher, creates equal highs or buy-side liquidity magnet, then pulls back. Price drops sharply below a recent low, hitting sell stops. This is our stop hunt. Immediately, price rockets higher with large, energetic candles, breaking the previous swing high. This is our displacement, confirming intent. It leaves a fair value gap and a bullish order block in a discount zone. We wait. Price slowly retraces into that FEG, tapping the order block. This is our optimal entry point. We enter long, stop loss just below the order block. Target the equal highs. This is a clinical, high-probability trade, executed with precision and aligned with the algorithm's objective. This is the model in action. This approach demands a fundamental shift in mindset. Patience over frequency, precision over prediction, and risk management as integral to execution. Retail traders are often addicted to constant action. Professionals know high-probability setups are rare, requiring specific conditions. You must develop discipline to wait days, even weeks if your setup isn't present. Value patience over frequency. Prioritize precision over prediction. We don't guess future market positions. We observe the algorithm confirming its immediate intent, leaving clear footprints, then join with defined risk and clear objective. Our entries are surgical, targets logical, exits predetermined. And finally, risk management is not an afterthought. It's core to execution. Entering at validated institutional reference points, order blocks, FEGs, allows tight, defined stop losses. We don't hope for turns. We enter where the algorithm reacts. If that level fails, the narrative changed. We exit immediately. This is professional risk management, unwavering capital protection. Embrace your stop loss. It's your ultimate guardian, a testament to discipline, ensuring you trade another day. As we conclude this series, I urge you revisit your charts. But this time, see not the noise, not lagging indicators, not chaotic candles. See the underlying structure. See the precise pools of liquidity above highs and below lows. See the order blocks where institutions left their mark. See the fair value gaps the algorithm must fill. Observe the time of day and session. Recognize premium and discount zones. With this understanding, the market is no longer a mystery. It transforms into a transparent, repeatable, professional environment, governed by rules you now comprehend. This ICT 2016 core concepts model is timeless because it's based on fundamental capital movement mechanics. It relies not on trends or fads, but on the inescapable reality of liquidity and the algorithm's pursuit of fair value. It's built on the footprints of powerful financial institutions, rewarding the patient, disciplined, and precise, while punishing the impulsive. Approach markets with this calm, confident perspective. Stop being targeted liquidity. Trade with it. Professional trading isn't more information, but deeper understanding. You have the core concepts, reference points, and the model. Now master the discipline to apply them. Be patient. Be precise. Be professional. The market will always offer opportunities for those with eyes to see and hearts to wait. And this is the end of our introduction, but the beginning of your journey into the inner circle. The algorithm, the liquidity, the model, they are now yours. Go forth and apply this knowledge with unwavering discipline.